I have lived long enough to know that the market rarely steals your money in a dramatic way. First, it usually distracts you first. It puts a war on the screen, it flashes oil prices across the bottom, it gives you labor data, interest rate guesses, recession odds, AI panic, political sound bites, and 1,000 opinions from people who sound certain for about 48 hours. Then, while everyone is looking at the noise, it quietly marks down a handful of exceptional businesses. That is the part most people miss. They think the opportunity begins when the news clears up. They think the bargain appears after the fear has passed. They think the time to buy is when the narrative is comfortable again, when the headlines stop feeling dangerous, when somebody important gives them permission to feel calm. But I have never found that to be true. The market pays you for doing emotionally difficult things, while other people are busy finding reasons to postpone them. And one of the most common reasons people postpone a good decision is that they allow the macro story to drown out the business story. I have watched that happen again and again. A strong business gets thrown into a weak basket. A company with a durable moat gets sold as though its economics have been permanently impaired, when in reality investors are simply no longer willing to pay the same multiple they paid 6 months earlier. A stock that used to be called untouchable gets renamed vulnerable. A business that was celebrated as inevitable gets reintroduced as risky. The facts do not change nearly as fast as the adjectives that matters, because when adjectives change faster than economics, prices can move a lot more than intrinsic value. And when that happens, patient buyers get invited into situations that looked impossible only a short time earlier. Lately, I have been thinking about that because we are living in another one of those moments. People are staring at chaos. They are staring at conflict in the Middle East. They are staring at oil. They are staring at whether the labor market is slowing, whether the Federal Reserve will cut, whether growth is fading, whether inflation will come back, whether AI will replace this job or that job, whether the market can rally first and then collapse later, whether the stock market is detached from the economy, whether every new development means we need a whole new framework for investing. That sort of environment can exhaust people. It can make them feel as though discipline is naive and conviction is reckless. But most of the time it is exactly that environment that creates the opening. Not because the world becomes simple, it never does, but because people start pricing good businesses as though complexity itself were a permanent impairment. That is rarely true. What is often true is that investors get overwhelmed, funds de-risk, analysts turn cautious, and a group of very high-quality businesses fall into drawdowns large enough to matter. When I see that, I do not begin with a chart. I begin with a business. I ask a simple question. If the stock market closed for a while and I had to think like an owner instead of a spectator, would I still want a piece of this company? Would I still want the economics, the customer behavior, the moat, the pricing power, the management, the free cash flow, the competitive position? Or am I secretly relying on a better mood from the market to make my thesis work? That difference separates an investment from a trade. And in periods like this, it becomes very clear very quickly who was doing ownership thinking and who was renting confidence from the crowd. One of the first businesses that comes to mind in a setup like this is FICO. A lot of people understand the brand at a surface level. Far fewer understand the depth of the position. FICO is not just a product in a competitive lane. It is embedded language. That distinction matters more than most people realize. A language does not have to be technically perfect to remain dominant. It has to be widely shared. It has to be trusted by the institutions that use it. It has to be embedded in habits, workflows, contracts, underwriting, communication, reporting, and the mental model of the entire ecosystem. Once something reaches that status, you are no longer competing only on features or price. You are competing against coordination. That is a much harder thing to dislodge. When banks, lenders, originators, and counterparties all speak in the same scoring language, the inertia is enormous. Now, can people invent alternatives? Of course they can. Can they offer them cheaper? Certainly. Can regulators or market participants push for more competition? Yes. Can investors get nervous when a competing score becomes more aggressive about entering the market? Absolutely. That is what has happened. On top of that, the stock had run ahead of itself. Expectations were elevated. Guidance came in softer than the most optimistic people wanted. The market decided that a business once treated like an unbreakable toll bridge should be repriced with more skepticism. So the stock got hit. That does not mean the moat disappeared. It means the market stopped assuming perfection. And those are two very different things. I have always preferred buying a strong business after the market discovers it is not magic rather than before the market learns it is real. FICO now sits much closer to the former than the latter. The concerns are visible. The debate is active. The valuation is no longer pretending that risk does not exist. That is when I become more interested, not less. Because if the essential economics of the business remain strong and if the embedded position in the lending system remains largely intact, the return from here does not require fantasy. It requires resilience. It requires the company to continue doing what it has already spent years proving it can do. The next example is different in form, but similar in principle. Uber has become one of those businesses that many people still discuss as though it were a story stock, when in reality it is increasingly behaving like a scaled platform with meaningful operating leverage. That shift is important. A lot of investors got trained by the early years to think of Uber as a permanently promotional, permanently controversial, permanently unproven company. They remember the burn, the competition, the governance drama, the uncertainty. Those memories do not disappear just because the business improves. In fact, that is often what creates the opportunity. The market can be slow to upgrade its mental file. What I see in a business like Uber is not a company that has to win every argument in the future. I see a platform that has reached relevance in everyday life. The habit is there, the demand is there, the network is there, the brand recognition is there, the utility is there. And once a platform becomes part of daily behavior at scale, the economics often improve faster than the public narrative. People like to focus on the next threat. In this case, that threat is usually framed around autonomy, robotaxis, and the idea that technology will somehow remove Uber from the value chain. Maybe someday parts of transportation will look different. That is not enough to make me believe a scaled demand aggregator with brand familiarity, consumer habit, driver relationships, routing, marketplace data, and a global footprint suddenly becomes irrelevant. Markets love to jump from change to obliteration. Real life is usually more incremental than that. Even when technology does alter an industry, the companies that already own the customer relationship and the distribution channel often remain central. If anything, those positions can become more valuable if new forms of supply need demand aggregation. So when I see a business like Uber down materially from its highs while still trading at valuation levels that do not require heroic assumptions, I pay attention. I do not need it to be invincible. I need it to be durable and underestimated. That is enough. Intuit is another case where I think investors are allowing a fashionable fear to run ahead of a practical reality. The fashionable fear is AI. The practical reality is convenience. I have learned over many decades that people do not merely buy software. They buy reduced anxiety, they buy saved time, they buy fewer mistakes, they buy the right to offload a task they do not want to think about. Tax preparation is one of the clearest examples of that principle. In theory, many things look easy if you describe them abstractly. In practice, most people do not want to feed forms into a general purpose model, wonder whether the output is correct, worry about liability, and hope they interpreted a changing rule set the right way. They want something that feels direct, familiar, guided, and accountable. They want to click through a system designed for the problem. That is very different from wanting a clever answer machine. Investors sometimes confuse capability with adoption. A technology can be capable of assisting with a task without changing how the majority of users prefer to complete them. That is where I think the market has gone too far with some of the fear around Intuit. Can AI help with tax preparation? Yes. Can it change workflows? Yes. Can it increase productivity inside the product? Yes. Can it improve the user experience? Absolutely. None of that automatically means the dominant provider of the trusted workflow is the loser. In many cases, the opposite is true. The incumbent with the distribution data, compliance integration, consumer trust, and installed base is the one best positioned to incorporate the new capability. Yet the market often begins by punishing that incumbent as though the mere existence of a new tool makes the existing franchise obsolete. That is lazy thinking. On top of the AI fear, Intuit suffered the same thing many quality software businesses suffered. The valuation stopped receiving special treatment. Once the market withdraws the premium label, the multiple compression can do more damage than any temporary change in the business. That is what people forget. A stock does not have to become a bad business to become a bad stock for a period of time. It only has to move from beloved to ordinary in the eyes of investors. But the reverse is true as well. A very good business that gets repriced as though it now needs to prove itself can become an attractive stock precisely because the market has become too skeptical. I do not make money by pretending the concerns do not exist. I make money by asking whether the concerns are already embedded in the price more than they are embedded in reality. That is the question. Microsoft belongs in this discussion for a different reason. This is one of those companies the market usually treats as too obvious to be interesting. It is almost the definition of institutional quality. A business with deep entrenchment, broad distribution, recurring economic relevance, enterprise dependence, software scale, and multiple layers of optionality. Because it is so widely respected, many investors forget that even great businesses can become temporarily awkward owns when the narrative shifts. That is what has happened. Part of it is simple. The stock had become expensive enough that any wobble in sentiment could compress the valuation. But there is more than that. Microsoft is being judged through the lens of enormous capital spending, uncertain returns on AI infrastructure, and a relationship with OpenAI that investors once treated as a pure blessing and now increasingly treat as a source of concentration risk. That is a meaningful change in perception. The market used to reward the company for being close to the center of the AI excitement. Now it worries that the company is spending heavily, tying itself to one ecosystem, and moving away from the economics of a pure software business toward a more capital-intensive blend. Those worries are not crazy. They are worth thinking about. But good investing does not come from stopping at the existence of a worry. It comes from deciding whether that worry has already become so obvious, so repeated, and so heavily discussed that the stock now reflects it more than the likely long-term outcome does. In Microsoft's case, I think that is increasingly true. This is not a fragile company. It is not a speculative business trying to invent relevance. It is a deeply embedded operating system for enterprise productivity, infrastructure, workflows, and software ecosystems. Even if one part of the market becomes noisier, that does not erase the power of the installed base. Even if returns on some AI spending arrive more slowly than the market hoped, that does not mean the franchise is broken. Even if investors prefer a lighter capex story for a while, that does not make the business unworthy of ownership. Sometimes the market uses real concerns to justify unrealistic discounts. That is where opportunity lives. Brookfield is different again. This is not about software multiples or AI disruption. This is about macro sensitivity and the market's habit of moving quickly from uncertainty to broad suspicion. Businesses tied to capital flows, asset values, financing conditions, and long-duration investment programs will always attract more anxiety when the world feels unstable. If oil spikes, if inflation fears return, if interest rates appear likely to stay elevated longer, investors immediately look for businesses that might be disadvantaged by that environment. Brookfield gets placed in that frame, and there is some logic to it. Lower rates often make life easier for asset-heavy structures. Clearer macro conditions often improve confidence. When markets are messy, businesses tied to long-term capital deployment can be marked down even if their underlying assets and long-run capabilities remain intact. That is exactly the kind of situation I like to examine closely. Not because macro does not matter, it does, but because cyclical discomfort is often mistaken for structural impairment. And those two things are not the same. If a business is truly dependent on a perfect environment, I do not want it. But if a business owns valuable platforms, allocates capital intelligently, manages through cycles, and gets punished, because the current macro conversation makes people impatient, that can be very interesting. Brookfield has always struck me as a business where understanding management matters. The market can treat the structure as complicated. It can treat the earnings presentation as less straightforward than a conventional industrial or software company. That complexity can create a discount on the way up and a larger discount on the way down. But if you trust the capital allocation ability and the long-term asset development engine, periods of macro anxiety can present the ownership opportunity. Again, the key is not that the key is that the business remains capable. SP Global may be the clearest example of the market taking a real buzzword and applying it too simplistically to a deeply entrenched franchise. The buzzword is AI. The conclusion many jump to is that if AI can assist with research, summarize data, write analysis, or automate parts of knowledge work, then every information franchise should be downgraded. That is too shallow. Data is not just data. Workflows are not just content. Trust is not just information. And embeddedness is not just access. When a company becomes part of the plumbing of financial life, the challenge for competitors is not simply to generate comparable output. The challenge is to replace the habit, the integration, the regulatory acceptance, the brand confidence, the workflow dependence, and the decision architecture surrounding that output. That is a much taller order. Investors often collapse all that complexity into a single sentence. AI will commoditize it. Maybe parts of certain tasks become cheaper. Maybe some layers get pressured. Maybe some workflows evolve. That still does not mean a highly embedded financial information and ratings ecosystem loses its core importance overnight. I am always wary when the market takes a broad technological fear and applies it indiscriminately across every business with a similar label. That is usually a sign that people are sorting by story rather than by economics. What makes the SP Global setup even more interesting is that the business itself is not standing still while the stock gets marked down. When a company with strong cash generation uses that strength to buy back its own shares more aggressively into weakness, that matters. Management is sending a message about the gap between price and value. That does not guarantee a short-term result, but it does tell you something about internal confidence. And in times like this, I prefer to own businesses that can act from strength while others are reacting from fear. Now, if you step back from those individual cases, a larger principle appears. The market is not simply punishing low-quality businesses. It is repricing a group of companies that many of the smartest long-term investors in the world have spent enormous time studying. I do not mention that because famous ownership makes something right. It does not. But it does tell you that serious minds have found these franchises worth understanding. And when businesses with that kind of quality stamp suffer material drawdowns for reasons that are at least partly narrow, I want to pay attention, not because every dip is a bargain, some are deserved, but because the best opportunities often come when quality and discomfort meet at the same time. Most people can handle quality, most people cannot handle discomfort. That is why the combination matters. This is also why I spend so little time trying to forecast every macro twist. I listen, I observe, I think, but I do not fool myself into believing that my edge comes from sounding clever about the next month. I have heard too many people say the market will rise first and fall later, that oil is somehow good and bad at the same time, depending on which sentence they are in, that stocks are detached from the economy until they are suddenly attached again, that some new event changes every rule and must therefore justify a brand new emotional reaction. That style of commentary can be entertaining. It is usually a poor foundation for capital allocation. One of the more dangerous habits in markets is the habit of turning uncertainty into choreography. People start speaking as if they can narrate the path with precision. The market rallies into month end. Then a bear market arrives later. Growth outperforms even though the economy weakens. Higher oil is fine for stocks until it is not. A correction is healthy, except when it becomes something worse. I do not think that way. I have never believed that my returns would come from pretending the future owed me a neat script. My job is not to perform certainty. My job is to make sensible decisions when the odds are attractive. That requires humility. It also requires separating what is dramatic from what is important. Higher oil can matter, rates can matter, economic weakness can matter, but if I spend all my time reacting to every moving variable, I stop doing the one thing that actually creates long-term returns, which is buying durable businesses at prices that leave room for good outcomes. The business comes first, the ownership logic comes first, the price paid comes first, the rest is context, important context, sometimes painful context, but still context. The same principle shows up in the way people talk about technology and employment. Every cycle produces a fresh wave of voices telling the public that this time the damage is permanent and the future belongs only to fear. Those voices always sound intelligent because fear can borrow the language of realism. It can dress itself up as sophistication. It can point to selective data, a conference, a fast-growing startup, one dramatic anecdote, one executive quote, one industry under pressure, one graph that looks terrible, and then imply that the broad economy is about to become unrecognizable. I have heard some version of that story for most of my life. The names change, the emotional structure does not. This time, it is AI, before that it was something else. Before that it was something else again. The public gets told that entry-level white-collar work is about to disappear, that coding is over, that trucking is over, that the labor market is about to collapse, that social disorder will inevitably follow, that human beings are on the edge of economic irrelevance unless government rushes in with a solution. That sort of rhetoric spreads because it is vivid. It is also usually incomplete. I do not deny that technology changes jobs. Of course it does. I do not deny that some skills get repriced, some tasks get automated, some roles get pressured, some industries hire aggressively at one point and pull back later. That has always happened. What I object to is the leap from transition to doom. That leap is one of the costliest intellectual mistakes an investor can make, Because when you accept doom too quickly, you begin seeing every efficiency improvement as purely destructive. You stop seeing reinvestment, you stop seeing new demand, you stop seeing margin expansion translate into new projects. You stop seeing productivity lead to broader output. You stop seeing that businesses which can do more with each employee often have a greater capacity to build, not less. This is one reason I dislike selective fear narratives. They focus only on the visible displacement and ignore the invisible creation. That is a terrible way to think about the economy. It is also a terrible way to think about investing. If you had used that framework for the internet, for enterprise software, for modern logistics, for automation in manufacturing, for advances in agriculture, you would have consistently misunderstood the balance sheet of progress. The losses are obvious. The gains arrive through second and third order effects, and those effects are where great investment opportunities often come from. So when I hear someone suggest that the future is mostly a parade of disappearing jobs and social collapse, I do not become enlightened. I become cautious about the speaker. Fear is not analysis. And panic dressed up with selective facts is not wisdom. What matters to me is whether a business is getting stronger, whether it is serving a real need, whether it is building trust, whether it can translate productivity into durable economics, and whether the market is pricing it according to a temporary emotion or a lasting reality. That is the discipline. That is the work. And that is why this kind of market is so interesting to me. You have war headlines on one side, you have oil spikes on another, you have people debating whether the market will melt up or crack down. You have AI fear being applied indiscriminately to software, data, services, and employment. And right in the middle of all that, you have a set of very high-quality businesses trading far below the levels where investors were recently happy to own them. That is not a coincidence. That is what markets do. They create emotional weather severe enough to separate price from temperament. The investor who needs emotional comfort before buying will almost always arrive too late. The investor who demands a spotless macro backdrop will almost always pay too much. The investor who confuses a lower multiple with a lower quality business will miss many of the best compounding opportunities. I have learned to treat those habits as expensive luxuries. I do not require a perfect sky. I require a sound business, a sensible price, and a long enough runway for the economics to matter more than the commentary. That is what I see in situations like these. I see a credit-scoring franchise whose language advantage remains stronger than the current fear implies. I see a transportation platform whose scale and habit are worth more than the market's mood. I see a tax and financial software business whose convenience and trust are likely more durable than the loudest AI narrative suggests. I see a software and cloud giant being repriced for spending and concentration worries that may already be largely reflected. I see a world-class alternative asset allocator marked down by cyclical macro discomfort. I see a financial information and ratings platform treated as though broad technological anxiety automatically erases deep institutional entrenchment. In other words, I see businesses, not slogans, not panic, not entertainment businesses. That is where I want to live as an investor. Because if I can stay there, if I can keep bringing myself back from the noise to the economics, from the headlines to the franchise, from the crowd's discomfort to the owner's question, then I give myself a chance to act rationally while others are acting urgently. And a great deal of long-term investing is nothing more glamorous than that. It is not brilliance every day. It is composure on the important days. It is refusing to let fear markets write your underwriting for you. It is knowing that quality can go on sale for reasons that have more to do with narrative pressure than with business decay. It is understanding that when everyone wants certainty, the best available asset is often patience. The crowd usually wants an all-clear signal. I have never seen one. What I have seen are moments where prices embed enough pessimism that I no longer need perfection. I only need competence, durability, and time. That is the kind of opportunity I take seriously. And that is why, when the world gets loud, I try to become quieter. I read more carefully. I think more slowly. I ask whether the fear in the stock is larger than the damage in the business. If the answer is yes, I lean in. Not recklessly, not theatrically, just rationally. That is how capital compounds, not by reacting to every piece of chaos, but by recognizing when chaos has made good ownership available on better terms. Most people will spend periods like this trying to predict the next headline. I would rather spend them identifying the businesses I will be glad I owned when the headlines are forgotten, because they will be forgotten. They always are. The war panic will be replaced by another panic. The oil spike will become a memory. The labor scare will find a new statistic. The AI fear will move from one industry to another. Commentators will keep speaking. Narratives will keep rotating. But the businesses that survive all that, the ones with habit, trust, pricing power, embedded workflows, scale, and cash generation, those are the businesses that keep doing the heavy lifting long after the emotional weather passes. That is what I want. And when the market sells them down hard enough, I do not treat that as a reason to look away. I treat it as an invitation to look closer.